This stock investment strategy will make you rich. Welcome back to the channel, and if you're new to the channel and don't know me, my name is Alan. I'm a 32-year-old entrepreneur based in the UK. I talk all things entrepreneurship, personal finance and startups, and by 32, I've been involved in selling businesses, startups, managing portfolios of multiple companies and investing in multiple asset classes. One of those asset classes is stocks, and today we are diving into an investment strategy that can transform your portfolio and build wealth like you've never seen before. Imagine being able to find stocks that not only are cheap and present value to you as an investor, but are also poised for explosive growth. In this video, I'm going to walk you through a powerful blueprint that top investors and top fund managers are using right now. This strategy combines the best of both worlds of value and growth investing, and here's the kicker. I'll show you how to uncover these opportunities in less than 2 minutes. Stick around as I walk you through this investment strategy, and I'll also reveal one of my own investments that benefited from this strategy and ultimately sold, making me a tidy sum in the process. Let's get into it. Firstly, we need to give an overview on the difference of value and growth investing, as we'll be combining both of these later in the video. Value and growth investing are two different schools of thought and each have their own philosophy, strategies, and notable figures who champion these methods. Value investing is the hunt for undervalued gems. This strategy is focused on finding stocks that are trading below their intrinsic value. Investors who follow this approach believe that the market often overreacts to good and bad news, which causes stock prices to fluctuate based on emotions and not long-term fundamentals. If you think about what I've just said, think about yourself. You're a human being, but as human beings, we are emotional creatures that can sometimes have irrational reactions to certain situations. As you can see from the graph on your screen right now, this shows the MSCI World Index in 2020, and we can see a sharp fall in the market from around mid-February to the end of March, with a recovery starting by the end of March. As we all probably remember, the catalyst for this was the announcement of lockdowns and the pandemic getting into full swing and the world literally shutting down for 6 weeks. My point is, the market overreacted by losing over 30% of its value when the long-term fundamentals of particular companies at that time in certain sectors at least were very strong still. The most famous guru of value investing is Warren Buffett, who is often referred to as the Oracle of Omaha. Buffett, the CEO of Berkshire Hathaway, has consistently outperformed the market by sticking to a value-orientated philosophy, and he learnt this approach from Benjamin Graham, widely considered the founding father of value investing and the author of the book, The Intelligent Investor. A famous quote from Warren Buffett encapsulates the essence of value investing: "Price is what you pay, value is what you get." This investment strategy highlights the importance of understanding a stock's intrinsic value, not just looking at the perceived market value. Okay, you now understand the principles of value investing, so let's run through growth investing. Growth investing focuses on companies that are expected to grow at a faster rate compared to the market average. Growth investors tend to seek businesses that have the potential for future expansion, and this has included in the recent years the technology sector, which has been booming. Unlike value investing, these companies tend not to be undervalued and they typically trade at a higher price to earnings ratio. In case you're unsure of what a price to earning ratio is, or as it's commonly referred to as a PE ratio, this metric measures the valuation of a company's share price by dividing the current market price of a company's share by its earnings per share. Make a note of this now, as we'll be using this as part of our investment blueprint to generate some weighty returns for you. If you're interested in growth investing, Philip Fisher, who is a key figure in the world of growth investing, published a book called Common Stocks and Uncommon Profits, and this has been influential in shaping the strategies of many growth investors today. Okay, so you now understand both value investing and growth investing, so let's get down to the strategy that combines both of these, and also what else to look for when we are picking an investment with the potential for explosive growth. Before we move on, if I could ask you all to ring that bell, like and subscribe. I need more fantastic viewers like you, and not only that, if you subscribe, you'll be alerted when my next videos land on this channel. Let me introduce you now to the Zulu Principle, which was written by legendary investor Jim Slater. Now, keep watching this video, everyone. As I mentioned earlier on, I will show you how to implement this principle in a space of minutes. When I started investing at age 19, I used this principle but had to work out all the metrics manually, which took me hours, which was an absolute ball ache. But if you stick around to the end of this video, I'll show you on screen how I do this in a matter of minutes. Before we do that, I want to run through some of the principles of the book, but I urge you all to read the book in full, as it has some great lessons. And even though this was written in 1990, before I was born, and yes, people, I'm not that old, it has aged terrifically, and I have linked to this book below in the show notes. Do you remember earlier when we discussed the PE ratio? Well, now this is the time where value and growth investing combines, which is part of the secret sauce to make you rich. Jim used a metric called the PEG ratio, which measures the PE ratio relative to the growth rate of the company. The PEG ratio, to fit part of the Zulu Principle criteria, needs to be below 0.75, and let me give you a real working example of this. Alan's bike shop has a PE ratio of 10. Expected earnings growth next year is 25%. If we divide 10 by 25, this equals 0.4, and as a result, this would fit the criteria as this is under Jim's golden number of 0.75. Okay, let's run through some of the mandatory criteria when assessing investment based on the Zulu Principle. But before this, if you have got the itch and you want to start looking at investing today, I've struck up a new partnership with Trading 212. With a choice of over 13,000 global stocks and ETFs and commission-free trading and 24/7 support, Trading 212 is the platform that I recommend to you all today. Click link in the show notes below and start your investing journey today. Okay, back to mandatory investing criteria. We've run over the PEG ratio and how this works, but we also need to ensure our PE ratio isn't over 20. The preferred range for a PE ratio is between 10 and 20, with forecasted growth rates of 15 to 30%. If growth exceeds 30% levels, Slater thought this could be unachievable for a lot of companies as competition could come in and slash the prices, which would have an effect on the growth rate of the company. Also, strong cash flow per share in excess of earnings per share, both for the last reported year and for the 5-year average, is key. In addition, strong financial liquidity is key, meaning there is lots of cash in the business. A financial indicator called high relative strength, which in essence shows momentum of the stock, is also very important. This is more of a technical indicator rather than the fundamentals, and my stock screening tool at the end of the video will do the work for you. A good competitive advantage is key, which is usually evidenced by a high return on capital employed. For all you numbers people watching this video, a figure to look for is higher than 12%, but ideally nearer 20. Good operating margins relative to the industry is vital, but again, as I mentioned previously, if the margins are too high, competition could come in and slash those margins by reducing prices. And finally, no selling of shares by directors. And if we think about this in more depth, this makes sense because imagine if the CFO of a company starts selling lots of shares. This would probably be worrying as this is the person who runs the numbers on a day-to-day basis, and it could be an indicator of struggles for the business ahead. Okay, so all of the above is the mandatory criteria set out in this principle, and if some of the terminology is a little hard to follow, I'll show you at the end of the video how to find these opportunities within minutes. In terms of highly desirable criteria, Jim Slater liked to see a group of directors buying shares in the company paying a dividend, and the company having a small market capitalization of between 30 and 250 million. And for those of you who don't know, the market capitalization is a way to measure the company's size. Slater liked investing in small companies, and he coined the phrase, "elephants don't gallop," meaning blue chip companies cannot experience the same growth as companies based on this criteria. Okay, so we've been through the full criteria, and it's important you've made notes of this, as this will also allow you to understand what to look for any business that has value and growth opportunities, and you'll now understand how to apply this to your strategy. Now I'm going to show you how to find these opportunities within a matter of minutes. Right everyone, on screen right now, what you can see is Stockopedia. I'll give you a very, very brief run through, and then I'll show you how you can find the Zulu Principle within 2 minutes and apply it to all your stocks as well, okay? So again, really good platform if you like looking at lots of information on stocks. So you can see there's obviously a community here, and community is really key with Stockopedia because you can actually engage on the platform a lot with other people. But you can see in the community, these are the most viewed stocks. You might want to have a little look at them. You can see what the FTSE All Share Index is doing today. You can change all these as well. S&P 500, FTSE 100. Also research, if you're into a bit of research. Using guru screens to find growth stocks with momentum. Now, we're going to be doing this in a second. But again, that will show you actually how to do this as well if you want even more in depth. So again, if I just scroll to the left-hand side of the screen, what you can see here is browse, and you can look at popular screens. So we can see here my friend Jim Slater's Zulu Principle screen. And if I click this, and again, I did tell you it was 2 minutes, you can see all the stocks here in terms of how they subscribe to the principle and how they work with the principle and how you can invest in them. You can see some of the rules here. I'm just scrolling over, PE ratios, EPS, etc., etc. You can see all of this, and it does it all for you in a matter of seconds. You can see here, these all subscribe to the principle itself, and there's quite a few to you to look at as well. Again, 0.1 all the way to 0.7. Remember in the video before, I said it's got to be below 0.75, the PEG ratio. We can see here that's the case of all these stocks. You can see there's some pension provider in the UK, it looks like. There's a few Turkish companies. I think I've seen a US company, Mtron Industries, which I've not heard of, but if you scroll over this, you can see market cap, sales, P ratio, momentum, stock rank as well. That's something on Stockopedia, which tells you how they rank it. So if you start using this platform, you go, do you know what, I trust their stock rank, you know, they've done well with them, you've done a bit of research. You could always combine that with the Jim Slater principle as well. So again, There's so much on here that you can do. And again, I'm not going to go in depth on this video into it because it's just to show you how to actually see the Zulu Principle screen itself. So again, just to recap very, very briefly, homepage is here, browse, popular screens, Jim Slater Zulu Principle screen, and you can see they're all the companies. I think I said a couple of minutes, but I'd say it's more like a couple of seconds. But if someone's timing me on the video, let me know in the comments below. And you can tell me how long it actually was, but you can see how easy it is. So yeah, Stockopedia, links below in the show notes. Give it a try. To give you an example of my success with this strategy, I purchased a company back in 2022 for around 68p per share called SureServe Group, and using the Stockopedia filter, I looked at all the metrics, read up on the company, and eventually this was taken private in 2023 and was bought for over 124p per share, which represented over an 80% gain on my investment, which was very well received, let me assure you. Right, everyone, this brings us to the end of the video. You've learned the difference between value and growth investing and how the investment strategy in this video has the potential to make you very rich, and how easy it is to add these types of investments to your portfolio using Stockopedia. As always, my friends, ring that bell and like and subscribe to my channel if you enjoy these videos, and I'll see you all in the next one.